Welcome to Barchart's series of webinars designed to educate you about a variety of market concepts, to inform you of the features and tools Barchart provides related to these concepts, and finally to offer you some trader's insight to help you make a more informed investment decision. Today's subject, expanding technical analysis with Bollinger Bands. Now, wouldn't it be nice if, here we go, whoops. Wouldn't it be nice if we could, have a tool that would help us determine if price had traveled too far too fast or alerted us that volatility in that price was about to change? Well, in 1980s, John Bollinger developed a technical analysis tool that measured volatility using a simple moving average and two trading bands around that moving average called Bollinger Bands. Now, traders use the outer bands as price targets for entries and exits. And furthermore, knowing that the bands represent volatility, traders can anticipate how far price could vibrate, travel from our moving average. And another application of Bollinger Bands is to take into consideration the width of the bands. In low volatility, the bands contract. In high volatility, they expand. Now, typically, we look for these moments as contrarian periods and alerting us that there's a potential change in volatility and price movement. Hello, everyone. My name is John Rowland, Barchart's head of trading education, and today I'm going to explain the concept around Bollinger Bands, and I'm going to show you three applications that you could use to enhance your technical analysis. Now, before we get to that, please welcome my partner and our moderator, Barchart's project director, Gene Baker. Hello, Gene.
Good afternoon, John. How are you?
I'm cold. I'm chilly. I don't know about you.
You want to talk cold and chilly? It's snowing here in Chicago.
No.
Yeah, it was just a small amount of snow. It started yesterday, but in light of that, I was looking for a something to talk about today. Today is Check Your Wipers Day. So if you are in a snowy climate like we are here in Chicago, you better go out and check your car wipers. Otherwise, you might be in a little bit of trouble.
Don't you always remember like that first snow and you got your wipers and then you turn your wipers on and it just like makes it worse?
Right. That's why it's Check Your Wipers Day, people.
They knew something, did they?
I guess. Anyway.
Ready to get started?
Yeah, I want to learn about Bollinger Bands.
Okay, great. Let's
All right.
jump right in. All right, just remember that today's is for educational purposes only, and decisions to buy, sell, or hold, trade in securities, commodities, or any other investment involves risk and best made on the advice of a qualified financial professional. And any technical analysis that we demonstrate, past performance is no indication of future results. And under no circumstances shall we be liable for any loss or damage you or anyone else incurs as a result of any trading activity that you or anyone else engages in based on information or material that you receive through Barchart and our services. Okay, with that out of the way. So Bollinger Band definitions. What are we talking about? Well, Bollinger Bands are a measurement of volatility. Now, they don't predict price. Instead, depending on how we're going to use them, they alert us when price has reached a level of volatility. Now, they're designed based on two bands, which represents two standard deviations from a simple moving average. Now, let me be aware of a correction that needs to be made on this slide in this definition. The moving average is a 20-period moving average. And my assumption was that we were going to use daily charts, and that's not correct. whatever time frame you are looking at, the Bollinger Bands will be calculated based on the time frame of the chart. In other words, dailies would use 20 daily period, weekly 20 week period, 60 minutes, 60 20 periods, 60-minute 20 periods. Okay. Now, traders, right, use them to determine overbought and oversold zones. Now, this is an important point. They help us determine when price has reached a level of extreme, and they are used in concert with other technical analysis, be it, let's say, a candlestick price pattern, some momentum indicators, what other technical analysis you might use in your daily process. And the bandwidth, the distance from the upper band to the lower band, can play an important part in our analysis. And Bollinger Bands can be applied in all time frames. They can be used in all time frames. Now, later I'm going to show you a technique where we use 3 different time frames to construct a strategy. But like all technical analysis, they have greater significance the higher the time frame. Okay, so let's talk about some applications that we're going to use for Bollinger Bands. So the first application is when the bands are narrow and price has, let's say, consolidated, like gathering energy, I kind of like to call. When price breaks out of these narrow bands, this is an indication that volatility is returning and that price movement of greater significance is about to come. In other words, it's an anticipatory saying that bands have narrowed and now price volatility is about to expand. So let's go back to that chart, that crude oil chart that I showed you before on our opening. And let me go over here a little bit to the left. So first of all, how do we add Bollinger Bands to our screen? Well, we can just go to studies here, and there you can see Bollinger Band here. But anytime you search for a study, you can just type it in. You can just type in Bollinger Band and it would pop up. And you could add it that way. Now, if I go to add Bollinger Bands, notice that there are some defaults here. So the default here, again, is our 20 period, and our width is our standard deviation. In this case, 2 standard deviations. Now, you might change this based on your analysis, right? For instance, if you're working in weeklies, you like weekly Bollinger Bands, but maybe you like to think about weeklies in terms of a quarterly event, let's say quarterly of the year. So maybe you might only use a 13 period, or maybe you're looking, something that's relatable to, let's say, a 200-day moving average. Well, that might be a 40 period. So you can adjust this accordingly, but we're just going to stay in the 20. And again, you can adjust the standard deviation as well. Now, what you can also do is we can create a template. Now, if you don't know how to create a template, we do have educational videos on our website that shows you how to do it, or just write to support at barchart.com. And I have a template which just says Bollinger Bands, and that's all it is. It's just Bollinger Bands. And so when we look at our Bollinger Bands here, the green here is my lower band, the red is my upper band, the shaded area is the width of the band, and the middle line is what we call our mean or our moving average. Now, let's talk about that first application. Right, we're going to look for when bands narrow. See how the band here is getting narrow? But as price moves from, let's say, the mean to the outer band. So let's focus on these 3 blue arrows. And notice that how price moves from below the middle line, our moving average. Now, it moves towards that outer band. And at the same time, notice that prior to this movement, that our bands were narrow, contracting. Energy is being compressed here, right? The market is waiting for some kind of a catalyst to make price move. And when price reaches the outer band and then at the same time breaks away from resistance, this is a bullish signal. And notice that the bands start to turn out. And this is an indication of a period of what we call high momentum and the beginning of a price movement, i.e. a trend. So again, let's look at this blue arrow right here, right? Our bands narrowed. Our price action went from the mean to the outer band, and then price broke out of resistance as we reached the outer band. The bands turn out, indicating that momentum and volatility is coming back into this market, and then a trend develops. So when we look at this type of scenario where we have narrowing bands and breakouts, then we're going to apply our trend following type strategies. Again, notice here, our bands came into a narrowing, then price broke out of the band, our bands turned outward, and price moved, in this case, very violently. And sometimes that's what you'll see. Sometimes price will carry along the bands. Sometimes it'll move violently outside of it. Again, notice here, our bands kind of narrowed here. Then this green candle broke out of this range that we had established, and volatility came back in, and price moved up. And so at this point, when the breakout occurs, we're going to use our trend following type strategies. Do this. Okay. So this is Tesla. And so notice again, here, again, I've kind of highlighted this, right? Our bands kind of came into a cycle of consolidation. We were range bound, and then we got a candle that broke out of the bands at the same time, broke out of resistance, and that it was a signal that a new price trend had developed. Now, it doesn't always have to work for uptrends. It can work for downtrends as well. Again, here we see price, our moving average is starting to turn downward, but price moved from the mean to the outer band, and at the same time, price broke down from support, and that created that high momentum that allows us to use a trend following system. Again, if we look at what has just recently happened, you can really see it based on these two arrows, where our bandwidth got narrowed. Our market was consolidating, it was gathering energy, and then price went from our mean to outside our outer band, at the same time breaking support and signaling a new trend. Now, in Tesla, at this case, at this moment in time, yeah, price is kind of fallen, but we're not getting that acceleration yet. So there could be something else going on here. Maybe we'll get a chance to look at it. But still, the process is still the same. Narrow bands and then looking for those breakouts. So the second application is when our bandwidth is wide. This is a sign of high volatility, and the price is accelerating, right? So the expectation is that the volatility and price will revert back to the mean. In other words, price has stretched the band, and it maybe has gone outside the band. Maybe you'll see what we call a piercing, a large wick or a shadow on a candlestick. Now, ideally, in these types of scenarios, we would like to see the whole candle or a good portion of the candle outside of these wider bands. Then the expectation is that the pressure that drove price and volatility, when it decreases, in other words, buying or selling dries up, then price will snap back to normalcy. In other words, revert to the mean. And this is when you're going to use a mean reversion strategy. And typically, this is how most traders use Bollinger Bands. Let's go back to crude oil. So what I've done is I highlighted a couple trades here. Notice the red arrows that are highlighted. And what we're looking at here is, let's say price is now, you can see price has fallen. It's fallen very fast in a very short period of time. And now the bands are starting to get wider from where they were. And price gets outside of the band, telling us that this is a rare occurrence outside of 2 standard deviations. Now, the math behind 2 standard deviations says that at 95%, right? This is a very low occurrence probability, but it's also telling us that there's a lot of volatility in the market, and that when that pressure, that push price outside the band is relieved, price will snap back to the mean. Sellers are in control, sellers push price outside the band, and then we got a green candle. Buyers step back in. Once price moves back inside the band, there's a higher probability now that price is going to revert back to the mean. Again, sellers are in control, sellers push price too far, too fast. That selling pressure is decreased, buyers step back in, price moves inside of the band, higher probability we're going to revert back to the mean. Now, many times you will notice this in Bollinger Bands is you'll go from one extreme to the other, and that is very common as well. So once price recaptured the mean and traveled towards the outer band, could you use a trend following system? For sure. But again, we might want to still think about our trend in maybe a higher time frame. Now, this is in a daily, but we'll investigate that in a moment. Now, here we see price moves very far in a short period of time, and price gets outside the band, and then buying dries up, and then price returns in here. Now, if I was a candlestick theorist, what is this candlestick pattern? Well, this candlestick pattern is what we call a cover cloud, right? Here we have maybe what we could talk about is, a drop-based rally, or, this is not really a spinning top or a doji, and maybe not even a morning star, but this is definitely a nice reversal pattern. So here are 3 examples of reversals based on volatility in that mean reversion concept. So Bollinger Bands can be used for all markets, right? Not just futures markets here, as I showed you with crude oil. So here's currency. This is the euro US dollar. Now, here's the caveat of using Bollinger Bands and this mean reversion concept. Notice here with the euro is we have several opportunities where we see the whole candle or a good portion of the candle is outside the lower band. But what's our trend? Well, our trend is down. So many times this mean reversion strategy is a difficult strategy to do because we're going to be taking a position that is opposite of our primary trend or the trend that we're looking at. And this can be risky. So it's important to have good risk management when you take these types of trades. But let's visit a couple of these in terms of structure and what is going on. Again, what did I say to you? I think we like to find when we find the whole candle outside of our Bollinger Band after price has expanded the band. Now, this one wasn't a great expansion, but certainly in terms of candlestick, that is definitely one of our Morningstar dojis, right? Now, those of you who were in my candlestick pattern webinar a couple of weeks ago, you will recognize this as that 3-candle crash and that waiting for that green candle to give you that signal. So here you'd have 2 indicators that would have given you a buy trade. Now, here we see bands are much wider, and this one worked just as well. But again, the whole candle is outside of the Bollinger Band, and then once price is released, that pressure, then price reverted back to the mean. Again, down here, same thing. Whole candle outside and reversion back to the mean. All right, so we have 2 concepts now. Narrowing bands, breakouts, trend following. Wide bands, price has gone too far, too fast, mean reversion. So what we're going to do now is we're going to blend these 2 strategies and we're going to break it down from higher time frames to our intraday time frames. And what we're going to try to do is find those opportunities where either our band width and our band volatility are showing us the same, or what we might look for is a combination of a trend following system where we see a mean reversion entry that allows us to get into a trade. Now, let me see if I can make that a little bit more clearer for you. So let's go back. And so here's Tesla, right? I think this is where I'm going to go. Hang on a second. Now let me do this one first. Okay, so this is soybeans. And let me start. This is how we're going to do this process. Let me start from a higher time frame. I'm going to start at a weekly. So here I'm in a weekly time, 3 years, weekly charts. And so you got to just bear with me a little bit here. So what is my process? Well, the first thing I'm going to do is, I'm gone back in time a little bit here, is first thing I'm going to do is I'm going to just look at my weekly band to see where price is in terms of the band, maybe even to give me an indication of where I think our trend is going. So in this case here, if I'm right about here, our bandwidth on our weekly has narrowed, hasn't it, right? So what is that telling us? The volatility is coming out of the market. The other thing that I see here is that we're now starting to get that breakout, right? So we could start thinking about using a trend following system. Again, remember, I'm still on the weekly time frame, right? So now I'm saying, okay, I'm going to look for trend following bull scenarios, right? And so again, I could look for those types of opportunities. So what I've done here is I kind of just framed out my bands with this blue line here. This is the upper band. And then you can kind of see this little light blue here. This would have represented our mean at this time when we started to get towards that breakout. So now what I'm going to do is I'm going to drop down to a lower time frame, probably a time frame where I'm going to assess risk in terms of my trading and where I'm going to really look for a trend. The higher time frame is really kind of just giving me this, I've heard terms like, am I in high tide or am I in low tide, or is the tide moving in or is the tide moving out? And again, here's that. Let's blow this out a little bit. And I'm going to make this a little bit more. So here is that same box that we outlined based on our Bollinger Bands at the weekly time frame. And again, remember this blue line here represented the mean of our weekly time frame. So we said that now we're going to look for bull trend or trend following systems. So what do we see here? Well, at this time frame, our bands have narrowed again. Could we look for a breakout trade? Certainly that would be a very good possibility. But the other thing that we can start thinking about is wait for price to get out to the extreme and then wait for price to what? Revert back to the mean. In this case, our uptrend. So now I'm looking for an opportunity to re-engage my trend after price has done what? Broken out on momentum. So you can see that that happened here in this little red circle. So I'm not done yet. So now what I'm going to do is I'm going to drop down into a lower time frame. So I'm going to go down to a 60-minute time frame. Now be patient with me because I got to slide this way over. And you know, you can change this by date up here as well. But here it is. There's that blue box. Now remember, we saw a high momentum event in our weekly. We saw a confirmation of it in our daily. Price had moved away from us. Maybe we didn't want to chase price, but I have a trend following system that allows me to re-engage my trend. In other words, when price returns back to the mean. Now notice again, this was the weekly mean price. But here we see on the 60-minute time frame, we see that opposite price action, that contra price action to my higher time frame trends, where price has moved too far, too fast, the bandwidths have gotten too wide. We've got a whole candle outside, and price re-engaged my mean. In this case, it also was where price broke out from the previous level of resistance. So a retracement. So here what we're doing is we're using a lower time frame to find that contra trend movement that is going to give us a better timed entry with our trend. With our trend. Again, let's work backwards. Here's our daily. Right? We got that thrust, that high momentum breakout. Now I'm waiting for that return to engage the mean. I want the market to come back and test that moving average. Price comes back and tests the moving average at a lower time frame on a Bollinger Band extreme downside. That is a mean reversion type entry, yes, but we're taking a mean reversion entry at a lower time frame to re-engage our higher time trend. And then price moves away. Now let's move forward. The current. And again, let's start our process. So here's my weekly. And again, I just drew some lines here. Here's the outer band here. This is the outer band there. I'm kind of defining where we are. And I have another blue line right here. You can see right on my weekly mean. Where are we in this price range? Well, you know, you can see we're kind of just on the other side of our mean. And what's our price action? Well, we have come from a downtrend and now we're kind of, you know, trading sideways. So the market is waiting for some kind of catalyst. It's waiting for some kind of information, right? Waiting for that breakout. Notice how narrow our bands are. So I'm kind of indifferent about where we are on this time frame. But if I drop down to a lower time frame, again, daily, notice how our weekly mean is very close to our daily mean. So this might be an opportunity to re-engage price as it falls in this range, somewhere between our daily mean and our weekly mean. Now, do I see something that could give me that evidence? Yeah, a nice big explosive candle that came where we're at this time frame. We got one of those thrusts, those high momentums, right? This would be an area where we would be investigating, or an area where we believe that price is probably going to hold with these two means. Now I'm going to drop down to a lower time frame and notice that this blue line, remember that was our daily mean, this light blue line was our weekly mean, and price is now fallen inside of these two bands. And this is an opportunity for us to look for a contra trend trade. In other words, that price has fallen too far, too fast. Our bandwidth has gotten wide at our 60-minute time frame. We're looking for price to re-engage, right? Our upward trend, that's what we believe. And do I see structure? Do I see a candlestick pattern? Do I see technical evidence that price has fallen too far too fast, right? We're in an oversold zone based on our RSI. This is an RSI chart, and this is a MACD chart. So again, using all those pieces of information, oversold outside the Bollinger Band in a lower time frame that's re-engaging the mean or the uptrend of two higher time frames, and then we find, a nice morning star, reversal pattern, candlestick pattern. So this would be a good potential entry for us. Now, what's my risk? My risk would be just below this. So this would be a very low risk trade. Now, there's other technical analysis that I can use. One of the ones that I like to use is ATR, or average true range. Now, let's go back and look at soybeans. You can see their average true range here is around 27 cents. Let's go back to our chart and go back to our Bollinger Bands. Let's go to our lower time frame. And what do we see? Well, our band here, our outer band, or the high where we were from this morning, from from the high of the band, was around 1460, and our ATR is 27 cents. So in other words, 1460 minus 27 would put us around 1433, right? 1333. This high here that was created this morning when soybeans first started actively trading is around 1450. Minus 27 would be 1423. Notice how those two values falls inside of our band. In other words, for today, soybeans has fallen one ATR outside of our lower time frame bands. That is giving us a greater confidence that price is probably not going to go much farther today. And it's coming back into an area of support in a lower time frame, which happens to coincide with our mean. All right. So a lot of you might say to me like, well, John, this is really easy for you to do because you trade all these different markets. You're aware of what's going on to them, how can I find these opportunities, right? So, we give you a lot of great information on Barchart. So one of the things we could do is just go to our stock page, for instance, and here's our top 100 stocks. Now, what does this page represent? Well, it's telling us that these stocks are the ones that have high weighted alphas. In other words, these ones have been trending up, right? We know that these are going to have a positive price movement. So here's Ardmore Shipping Company, our corporation. Let me just go to my flip charts here. And wait until I change this to the Bollinger Bands. Let's see what happens here. right? But definitely this one has been trending upward. So again, I have information. I know that this stock has been one of the stocks that's been trending up. Look at me, there you go. You can really see it. But what happened? The bands narrowed. This stock that had a lot of momentum kind of paused, right? It fell below its mean. Then we got that thrust, that high momentum, right? Right there, you can see that in this circle here. And then have another thrust here. So I could go back down to my lower time frame. And again, same scenario. Here's where we see that confirmation of our trend, our thrust, our breakout of resistance, and those candles that carried through. Now, again, if I'm going to look for reversions, right? Wait for price to get outside the band and then revert back to the mean, or wait for price to go outside the lower band and wait for it to re-engage. But again, here we could do the thrust, right? We wait for that high momentum. So this area here is where price paused again, gathered energy, and then we got that breakout. Now, again, I said Bollinger Bands can be used for both bull markets and bear markets. Let's go to the bottom 100 stocks. These are the stocks that have negative alphas. In other words, these are stocks that have been falling out of bed, right? They have a definite downtrend. And the one that I see here is Carvana. And again, I've highlighted a couple spots here. First, we have this one, and let's go and look at this spot. Again, let me put my Bollinger Band on. Right? Nice uptrend, nice trend following, right? And then what happens? Well, price gets outside the band. We get a whole candle outside. So that's telling us volatility is come really high volatility in here, high probability that price has traveled too far. It's got a little overextended, and that there's a probability that price is going to revert back to the mean, which it did. But here I'm in a daily time frame, 6-month daily time frame. Now, if I go to my lower time frame, that 60-minute time frame, there's that blue arrow, right? There's our piercing outside. There's that candlestick. Looks like a nice evening star. And then price reverted to the mean. Now, this would have alerted you as a good opportunity to exit this trade, this long trade, if you were in it. But now it also is giving you clues that something has changed, right? The momentum has started to change. And at this point, if we go back to our higher time frame, that candle that was outside of our Bollinger Band that alerted to us that prices had gotten too extended was actually the turning point of this trend. Now, this trend went from 350 down to, we're down to $17. But let's look at this in terms of just recent. And again, our primary trend is down. Here we are still on a daily time frame. We got that little thrust breakout, but again, when the band got wide, that's when price got outside of my bands. That would have been an indication to me that a change in volatility is going to come. In other words, our mean reversion. Again, if I go to my lower time frame, the same red circle, right? Our bands have gotten wider. Price is outside the band. The bands got a little bit wider after a thrust, a high volume, high momentum. Again, candlestick pattern. And again, if I used my other technical analysis here on the daily, what did we see? Our RSI was in the overbought zone. And not only in an auto overbought zone, but if we use good technical analysis, we made a higher high at the same time RSI made a lower high, and this is called negative divergence. And this is another clue that there's a change in the momentum. So using basic technical analysis and then using our Bollinger Bands to help us time a better entry, or in this case, if you were long, an exit. Okay. Well, I see a couple of questions here, Gene. Let me pause and then we'll run through a couple other markets since I'm a little bit ahead of my schedule here.
Yeah, as long as John's taking a break to review questions, let me just recap a few things for all of you listening. The Bollinger Bands study is part of the interactive chart, and if you have an account with Barchart, whether it's a Barchart Premier account or even just a free account, you can easily set up a chart template with Bollinger Bands, and you'll be able to quickly apply that to any chart that you're viewing so that you can analyze these different patterns that John is teaching you. We also do have quite an extensive grouping of webinars and educational videos, some of them having to do with Bollinger Bands that you can find in our Learn section under Learn and then under archived webinars. Okay, John, back to you.
Thanks, Gene. All right, so I see a couple good questions here. First of all, one of the questions is, what kind of candles do I use? And the question is, do I use open to close, hollow? And it depends on my mood. No, I'm just kidding. But there are multiple types of candlesticks. So a hollow one would be more of your traditional, empty. Sometimes you see them as white or blacks. Candles, we use reds. The other is a candlestick that is based on close to close. In other words, the candle color is based on where is the close of yesterday versus the close of today. Or in other words, if the candle closes today below the close from the previous day, then that would be a red candle. If it closed above the close from the previous day, then that would be a green candle. And then a candlestick that is called an open to close candlestick, well, that one just looks at the price data that is in that candle. In other words, if I have an opening that is below my close, in other words, price went up, then that would create a green candle or a dark candle, excuse me, a hollow candle. If I had a opening that was above my close, price fell, then that would create a red candle. So, it doesn't really matter which candlestick, just be consistent about how you look at these. I personally like the open to close. Why? Because I want to see the battle that is inside of my individual candles. That really kind of tells me that battle between bulls and bears. Now, I go a little bit more in detail in that candlestick webinar from a couple of weeks ago where we talked about this process. So I like to use the open to close. So the next question I get here is, does the color of the candle matter? And in this case, depending on what style candlesticks you have, no, it really doesn't. I just want to know what the battle is, especially if we're looking at small body candles. The color of the candle is not that important. It's really more about the price action that happens with the candle. In other words, I could have a green candle that goes outside my Bollinger Band, right, an up candle, but if that green candle is still below, let's say, the previous day's candle's high or the previous day's candle's opening price, that would still tell me that, that could still be pressure. It's just telling me right now that there is positive pressure. Bulls are trying to hold the market up. But if price gets below that green candle, then that would be definitely a change in sentiment in the market. So, color candles doesn't really matter, especially when they're small candles. But larger candles, it does make a little bit more difference, right? That's confirmation of who's winning the battle between bulls and bears. So I see another question here about talking about the implied volatility, the volatility of Bollinger Bands versus, let's say, implied volatility. I guess you would say like in options. So again, the difference is on applied volatility, let's say using options, is a standard deviation over an annualized standard deviation over a certain period of time, where Bollinger Bands is just a standard deviation of the period of time that we're looking at. It's not annualized, so that's a little bit different. So Greg asked something about in previous classes how much you like ATR. Can you tell me some reasons why you prefer Bollinger Bands instead of Kettner Bands, which uses ATR? So if I'm using Kettner Bands and I'm using ATRs, I'm really kind of using the same two analysis, right? I do look at Kettner Bands sometimes for some confirmations, or I kind of like Kettner Bands to use as a filter, especially when I'm looking at some breakouts, or a filter in terms of figuring out my risk. But if I'm using Kettner and ATR, then again, I'm using basically the same information, where Bollinger Bands is more of that probability of price, right? That standard deviation price, just a little bit different way. Now, the way I use ATR is really kind of using it as a measuring stick, where I think price can go for that one particular day. Sometimes when I'm doing Bollinger Bands, for instance, when I'm doing that process, let's go to, here's, again, let's do our process. Here we are on a weekly on the Qs, and what's our trend? Our trend is down. Where are my bands? Well, they're kind of, right in the range, right? They're not expanding and they're not contracting. It just means that volatility is probably set in. Now, what has price done? Well, it's moved from the lower to the mean, right? So that is telling me that maybe there might be an opportunity to re-engage this downtrend. So at this point, what I might do is when I start looking for entries today based on lower time frames, then I'll take into consideration how far price might move to get to my entry, or how far price might move to get to my target. And that's where I'll use ATR, that measuring stick of how much price will move. Now let's just walk through the process on this one. So I've drawn two balloon lines. One is, I'm not worried about the upper movement, right? Because that's up around 330. And if I looked at my ATR, my ATR is only 7 on this one, 7.7, almost 8, right? That's too far away. That's out of the realm of reality, right? That's almost 40 points away. So I'm not even really concerned about that, right? If I look on the downside on the weekly here, again, that's probably too far away to have a realistic target. Now, if I'm using this as a swing trade, then I'm thinking, oh, well, if I have this price is going to move 40 points and my ATR is around 8, how many days does that need? I need 5 days of consistent price movement. So again, probably it's too far away. But if I go down to a lower time frame, now remember those blue lines, here is my mean, which was on my weekly, where I could say, hey, can I re-engage this little up price movement that re-engages my weekly downtrend? And certainly we could do that. And what do we get? Well, we got a Bollinger Band piercing, right? Our candle went outside of our Bollinger Band. Now, when I drew this circle here, how far did price move from yesterday to today? Well, yesterday on these two candles, the day before it was around 285, 82. So if we added about 8 to that, that would be around 93, 94. And where did price stop? Well, make this nice and big so we can see it. The high of this candle was 93.20. In other words, price moved one ATR outside of my Bollinger Band at a daily time frame. Would that give me more confidence in taking that short, or in other words, putting on a short position, right? Yeah, I'm re-engaging that higher time frame trend. Also, I'm getting a greater confirmation because what? Price has now gone outside of the bands after the band had did what? Expanded, right? So that is how you can blend the ATR at technical analysis with our Bollinger Bands. Now, again, let's go to a lower time frame. I don't see any great candlestick patterns here, but certainly this is kind of interesting. And I noticed this, yesterday is, you got 4 candles here that all have the same, opening highs, opening prices. That is unusual. That is very unusual. That really is telling you that there's probably a large institutional trader who is selling the Qs at this value, right? Notice that we got a little bit of a wick pierce, then we got another one, no wicks here, and they're all the same value, right? So that is very interesting. And notice that these 4 candles between 9 o'clock and noon were right in the heart of the first opening hours of the day. So that was even more significant to me. But what are our bands doing? Let's think about this in terms of our Bollinger Band analysis, right? Our Bollinger Bands have now narrowed in this time frame. So what is that telling us? The market is anticipating the catalyst, right? So if I'm still don't feel comfortable taking a short, I'm probably going to wait until I get one of those high momentum thrusts where we break this support level, or right, we cross over the higher time frame mean and we look to go and test the outer band of our weekly. That scenario doesn't seem logical to me at this moment, but it's certainly not out of the realm of reality. So this would be a great opportunity to look for still playing the short side. And again, showing that setup based on the ATR. Okay, so Greg, I hope that answers your questions. So Richard, one of my regulars, hey Richard, how's it going? Do Bollinger Bands work in lower time frames, such as 10 minutes or lower? Yeah, you can use Bollinger Bands in any time frame. Just realize that they become much more sensitive, and you'll see a lot of greater fluctuations in those bands. They'll increase and decrease, or expand and contract in a very short amount of time, right? So, again, we want more significance, right? We want higher confirmations, another confidence. That's why I think, do your Bollinger Band analysis in dailies and weeklies. Use those lower time frames to help define those contra-trend price movements that will give you an opportunity to enter a trade with your higher time frame. Now, whatever time frame that works, whatever markets you're trading, that depends on you. Just looking at a couple of the other questions here. I think, Greg, your question about the squeeze, send that to support. There's a couple guys there that love the squeeze. I think they will give you a really good answer. I don't have enough time to break that down for you, all right? So Luke asks, how do you deal with head fakes and unusual that occurs in these squeezes? Again, send that question to support. But listen, that's why if we're using a contra trend movement or a mean reversion, that's why we need to have really good discipline in terms of risk management, right? So again, remember, Bollinger Bands aren't a predictor. They're just a confirming that volatility is going to change, right? So that is important why we need to still use good risk management. Because yeah, no system is foolproof, right? I'm not claiming that. I'm just saying that this one just happens to have greater probabilities when we get to these times when the bands have gotten too far or prices gotten too far too fast. And so Scott, let's finish with Scott's question. Do you ever use multiple Bollinger Bands on the same chart? And I think what you're saying, Scott, is do I use a 2 standard deviation or a 3 standard deviation at the same time? Yeah, I do know some traders that do that. It's not really my cup of tea. If you think about in terms of probability, 2 standard deviations are at 95% that price is going to remain inside of 2 standard deviations. When you go out to 3 standard deviations, you're only picking up about 2 percentage points. I think it goes up to like 97%. So yeah, I mean, if you have a 3 standard deviation day, you have price outside of 3 standard deviation day, does that give you greater confidence in your analysis? Yeah, it certainly does. But it's just not my cup of tea. I know a lot of other traders do that. They'll use, or they'll use a 2, 2.2, 2.5, and a 3, right? And they'll say, hey, I'll wait for a higher rating and then, or wait for, let's say, get it up to 2.5. We get price up to like 2.5, but they won't take the trade until a confirmation trade until price returns, let's say, inside of the 2.2 or the 2.0. In other words, they'll be a little bit more patient about their entry and they'll wait for the confirmation as it comes out of those multiple Bollinger Bands. All right, so I hope that helps you, Scott. All right, let's do this and then we'll finish up today. Okay, so a couple of takeaways here. First, that again, Bollinger Bands are just an overlay analysis that can be used in all time frames. It has greater significance at the higher time frames of daily and weeklies. That's really where I would encourage you to use this. And it works best with other indicators and chart patterns. Works really great with candlestick patterns and look at, like, let's say your RSIs or any other momentum indicator. Strength of trend, maybe ADX would be a great another technical analysis that you could use. Narrow bands represents low volatility and price consolidation, and that is an expectation that price and volatility are about to expand. So low volatility, narrow bands, we're going to start looking for trades that use some type of trend following strategy. Wide bands alert us that prices could be overextended and that we're going to get that snapback, right? We stretch the band too far and price is going to snap back into our moving average. Mean reversion type strategies. But remember, bands don't predict price or trend changes. They just tell us that the conditions are right for a change. So a blend of the two types of strategies, the trend following and the mean reversion. In other words, let's look for those setups that are in the trend following at higher time frame, but the mean reversion timing or entry at the lower time frame. I want to see that contra trend movement into my higher time frame trend. In other words, price reverts back to the mean of a higher time frame trend. Okay. All right. I hope you guys enjoyed that session. It's one of my techniques that I use. It's kind of my bread and butter in terms of market analysis. And, I really do believe in this. All right, let's talk about upcoming webinars. So next week is Thanksgiving, right, Jean?
That's right, John. We're taking a week off.
We're going to take a week off, right? So we're going to be off for a week or two, depending. And so, if you want to know when we have our next session, just, submit your email address and we'll send you an update. Now, the other thing I want to remind you all is if you're a Premier member that on Fridays we have a new show called Market on Close. And what's just cool about this is we just went to a new platform And you can access this through our webpage right here, or you can do it through YouTube. And it's a lot easier to get onto our sessions, our Friday sessions. And we also, Gene, help me out. Is this the new address that we put up here for submitting questions?
Yes, questions for Friday's Market on Close show should go to marketonclose@barchart.com. I believe
Excellent.
before we had a different email address there, webinar-questions, which still works, but this one is directed directly to John and Tom's attention.
Yeah. So yeah, we encourage you to put in the questions. We don't get to every question. We do keep them, and maybe we might have a question, just a one question session, maybe in the future. But we do appreciate your questions. We'll try to get as many in. The other thing I would also encourage you is remember that all of our webinars are on our YouTube channel, and you can go there and watch these over again and again. And if you're watching on YouTube, I appreciate a like and a comment. Just tell me what you liked about it or didn't like. And if you don't want to talk about what you like or didn't like, just tell me what you had for lunch. That's put in a comment in there. I appreciate it. Well, boy, Gene, that went by a lot faster than I thought it was going to go today.
A lot of information covered.
All right, Gene. So listen, thanks, Gene, for another great session. Folks out there, be safe, be healthy, and until next time, the good of all trading.